European stock markets are expected to open lower Thursday on growing worries around China's stuttering economy and the potential for higher U.S. interest rates. At 2 o'clock Eastern Time, 6 o'clock Greenwich Mean Time, the DAX futures contract in Germany traded 0.6% lower, CAC 40 futures in France dropped 0.7% and the FTSE 100 futures contract in the UK fell 0.3%. European equities are likely to take their lead from Wednesday's weak close on Wall Street on renewed concerns of a continued hawkish stance from the Federal Reserve. The minutes of the Fed's July meeting showed a number of officials still saw the need for more interest rate hikes to combat still elevated inflation levels, potentially weighing on economic activity in the world's largest economy, a major global growth driver. Most participants continued to see significant upside risks to inflation, which could require further tightening of monetary policy, according to minutes published Wednesday in Washington. Additionally, the July Fed meeting came before a raft of U.S. data that underscored the resilient economy. Fitch may look at downgrading China's rating. Adding to the negative sentiment was the news that rating agency Fitch Ratings may consider rethinking China's A+ sovereign credit rating, especially if corporate debt conditions worsen and the government expands its balance sheet to support the companies. This comes amid fresh concerns about the country's property sector, which have contributed towards Chinese economic growth slowing sharply in the second quarter of 2023. Back in Europe, the economic data slate is quiet, with the Eurozone's trade balance for June unlikely to move the needle. Dutch payment company Adyen, AS/ADYEN, Danish medical devices manufacturer Coloplast, CSE, COLOB, and Swiss plumbing supplier Geberit, 6GEBN, are on deck for earnings. Crude slips as U.S. production hit three-year high. Oil prices slipped lower Thursday, dropping to two-week lows, amid worries that slowing growth in China and a continued hawkish stance from the Federal Reserve will weaken fuel demand in the world's two biggest economies. These concerns have outweighed a bigger-than-expected draw in U.S. inventories, especially after Energy Information Administration data also showed that U.S. production hit a new three-year high last week, close to the record high levels produced before the COVID-19 outbreak in 2020. By 2 o'clock Eastern Time, the U.S. crude futures traded 0.2% lower at $79.22 a barrel, while the Brent contract dropped 0.1% to $83.39. Both contracts were at their weakest level in 2 weeks, and were now down for a fourth consecutive session. Additionally, gold futures rose 0.3% to $1,922.65 per oz, while euro to US dollar traded largely flat at 1.0873.
It was another down day in Wall Street, as statements from the Federal Open Market Committee (FOMC) minutes did not reflect the level of unity among policymakers to pause rates as what was initially expected. Particularly, the key takeaway that most participants continued to see significant upside risks to inflation, which could require further tightening of monetary policy, was somewhat perceived to carry a hawkish tilt. The Fed funds futures still showed firm expectations for a rate pause in September, 88% probability, but doubts have surfaced for the November meeting. A 35% probability of a November hike is currently priced, up from the 28% a week ago. Given that the Fed reiterated its data-dependent stance in the minutes, it may still have to take a series of upside surprises in inflation to anchor down views of additional tightening, but for now, the minutes were tapped on as a catalyst for the risk rally to further unwind, alongside jitters in the Chinese space. U.S. Treasury yields largely held firm, with the 2-year yields hovering at the 5% mark as a reflection for a high-for-longer rate outlook, while the 10-year yields head for its October 2022 peak. The US dollar firmed, crossing its 200-day moving average (MA) for the first time since November 2022. That kept the pressure on gold prices overnight, minus 0.5%, which touches a new low since March this year. Its weekly relative strength index, RSI, has headed further below the 50 level, with further downside potentially leaving the 1,850 US dollar level on watch next. Asian stocks look set for a negative open, with Nikkei minus 0.88%, ASX minus 0.90% and Kospi minus 1.21% at the time of writing. Weak showing in trade data across the region continue to point to the prevailing headwinds in global demand, partly weighed by the low-for-longer growth conditions in China. Japan's exports registered its first year-on-year decline, minus 0.3% in 2.5 years, and along with a lower-than-expected read in machinery orders for June, minus 5.8% versus minus 5.5% consensus, that may support the Bank of Japan, BOJ, on its more gradual path of policy normalization. Similarly, Singapore's non-oil domestic exports, NODX, for July tumbled, with a larger 20.2% contraction year-on-year, way underperforming the 14.4% contraction expected. Given the headwinds to China's growth conditions, with property sector risks likely to drag for longer, while spillover default risks has reached the shadow banking sector, there are rising doubts on the country's 5% growth target for this year. The current bias is that the worst is yet to come for China, with a more subdued growth outlook across the export-dependent region likely to stay for the rest of the year. A firmer US dollar overnight has pushed the USD SGD to a new year-to-date high. The daily RSI in overbought territory may call for some cooling, but given that the pair has reclaimed its 200-day MA for the first time since November 2022, buyers still remain in greater control. The pair is heading past its 1.360 level of resistance this morning, where a 38.2% Fibonacci retracement level stands from its September 2022 peak to February 2023 bottom. Further upside may potentially pave the way to retest the 1.376 level next.